If you work for Procter Gamble or are particularly if you're a pre-retiree that's still at Procter Gamble, or if you are a retiree who still has a profit sharing plan at Procter Gamble, you have there's a very unique mechanism contained in the profit sharing plan, which is different than most retirement plans and allows you some very creative and dynamic planning options with an opportunity to be very flexible from a tax standpoint and opens up opportunities to control what tax bracket your income comes from. So if you are looking at your account, a statement, or if you get online and look, you've got several buckets within that profit sharing plan. Two of them will draw your attention to. One is the common stock, the Procter & Gamble common stock. The other is the Procter & Gamble preferred stock bucket. If you dive into those numbers, you will see the current market value, which is simple the amount of shares that you have multiplied by the current market value or the stock price. It's going to show you how much you have in that bucket. But more importantly, I'd like to draw your attention to the cost basis, or the acquisition cost of the stock. Now you'll notice that in the common stock bucket and the preferred stock bucket, that the cost basis on that preferred piece is much, much lower. And these are shares that were picked up by Procter & Gamble as part of the profit sharing contribution from prior years. So the acquisition cost is very, very low. Depending on how long you've been there, sometimes that's $10, $12, $15 a share. The stock's trading around 140. This is as of May 19th. The feature that's available is that you are able to go into that bucket, the preferred share bucket, pull those shares out of the plan separately from everything else. So you can steer where each bucket goes. That particular bucket, you have the option of taking some or all of the shares directly out of the plan. When they come out of the plan, just the cost basis is taxed as ordinary income. You can take those shares, pay Uncle Sam the capital or the ordinary income tax rate on the cost basis, and hold those shares, and there will be no taxes due until you actually sell the shares. You can also take the cost basis and avoid or shirk the ordinary income tax treatment by rolling just that piece over, pulling it out of the bucket, taking that small piece, the cost basis, rolling to an IRA or another retirement account, and then taking possession of those shares. And again, you keep the shares, continue to collect the dividend, and you won't be triggered with the capital gain tax until those shares are sold, which, generally speaking, is systematic over time. Sometimes folks, and this is all personal circumstances. Sometimes folks will just bite the bullet, pay everything now, and then diversify that piece. Others, it's a systematic exit from the stock over time. This is, again, personal preference. From a professional standpoint, it's not particularly prudent to have a very large percentage of your assets in one stock, but that's a conversation for down the road. The key thing to remember here is that when you make the election as a Procter & Gamble employee that has left, terminated, retired, when you make the election on how to treat that profit sharing plan, you get one bite at the apple. So it's very important to make sure that you're making an informed decision and mapping out how that asset's going to be utilized over the next 2, 3, 4 decades. Because again, once you make the election to close the account, that's the only bite at the apple you get. There's no redos. So you have an interesting opportunity because that plan provides a lot more options than the vast majority of retirement plans out there. We've been working with Procter retirees since the late 1980s, and there's some very creative and dynamic opportunities available. But it's important to map out your game plan, map out the best tax strategy, not just for the year that you retire, but for the next 20, 30, 40 years, however many years you're in retirement.